So some of this is going to kind of be a repeat of last week's agent training, but there have been a few things that have come to mind and some changes that are going to happen. But for any producers that are in the rooms with any of you, we'll cover some of these things, even though they were covered last week, and we'll have a little more time for questions on cattle, since that's what we're going to focus on. You know, we talked last week about cow-calf producer profitability starting to decline pretty terrible during October and now November. And I looked at the two big Monday sales in the state, which would be Dixon and Unionville, and we saw prices $2 to $8 lower at one market and $2 to $5 lower at the other market for steer prices this week. And you know, last week I said I didn't think we had a whole lot more downside, but evidently in a couple of days' time, it proves how wrong I can be. I did say there was a chance for it, but I didn't think it was a really high chance. But when you start losing $2 to $5 and $2 to $8, that cow-calf producer situation is getting a little worse. So with that, that's changed my mindset on some things that may be of importance to that sector. At the same time, it provides very good opportunities for those margin operators going forward. So slaughter cattle prices are really, really strong. I expect them to increase a little bit more. You know, have we reached the peak in the fourth quarter? Maybe. Have we not? Maybe not. I don't expect any type of huge decline in this price set. So we're either going to trade steady or trade slightly higher. In the 113 to 115 range is probably where we're going to be maintained for the rest of the year, looking from the weekly standpoint. But when we get down here to steer prices and hitting a little closer to home for most people, you know, we're looking at $725, $750 a head on steers, and that price is going to have looked to be lower this week than it was last week. I'm to the point now where if we have producers out there that are looking to sell calves straight off the cow right now, I don't think it's a good idea. I think we're to the point right now where we need to be looking at some weaning opportunities, adding weight to those calves. At the same time, you know, that provides a really good opportunity for a margin operator, for a stocker producer to buy these calves pretty cheap. Heifers are at a huge discount to steers right now, so for a margin y'all can hear my help, can't you? I apologize. The wife left, and this child is going to his grandparents here in a few minutes, but she's going to help me, I guess, this morning. But anyway, it provides a great opportunity for margin operators with these low prices on these calves. But cow-calf producers really need to consider weaning opportunities, adding weight to these animals. And when I say weaning opportunities, I don't mean wean for 2 weeks and then get rid of them. You know, if you're going to wean, you're going to have to add some weight to these calves to get any value out of it. So that's definitely at this point going to be looking past the first of the year before you market those animals. At the same time, you have to consider some tax implications that come along with that decision, and how income is going to impact you on that. So value's not very good from the cow-calf standpoint on selling these freshly weaned lightweight calves. Stocker producers are going to have a lot of good opportunities in buying those calves, because there's still going to be a lot of people that sell those calves just straight off the cow. This is weekly run auctions, 7 to 8 weight steer prices. They're not a really good indication of really how our 7 to 8 weight cattle sell. They are really not that great of an indication of what we're looking at in this type of animal, because a lot of these animals that we're selling as yearling cattle are a lot of times being sold in load lots somewhere. So this isn't a great indication, but I know Larry Moorhead was on here earlier, and I know he'll give me a hard time because yearling cattle prices are still a lot stronger than calf prices have been. They both all classes of these cattle have seen prices decline, but the yearling cattle prices have held up much better than freshly weaned calf prices, which is pretty typical of this time of year. But those slight price declines shouldn't be of too much worry, and we're looking at a time period when things are pretty good, and margins for most of these cattle that are coming out in load lots are still positive for most producers. Now, here's something that's just all over the place, terrible. It doesn't matter. I was visiting with several livestock economists yesterday across the country, and everybody's got complaints on slaughter cow prices. Some people want to blame it on slaughter capacity, which slaughter capacity could be part of the problem. It could be that 90% lean beef prices aren't that strong, but I really don't think it's a slaughter capacity issue, because in the northwest part of the country, prices are still really low, and they have plenty of slaughter capacity for slaughter cows. Of course, they slaughter a lot of dairy cows, which plays into this at the same time. So the increase our dairy cattle slaughter, that dairy cow slaughter is also weighing on this market. But look for these prices come April, May to shoot back up into that 55 to 60 cent range next year. I think probably what this is going to do for some producers, there's some cows that people would normally cull this time of year that they may end up just holding on to them and trying to get one more calf out of them, because they don't want to take 40 cents for a 1,200-pound cow. Now, is that going to happen for everybody? I doubt it, but there will be some that will make that decision across this country. Slaughter has been really, really strong all year. Slaughter year to date for heifer and beef cows both has been up all year, but it has slowed down compared to year-ago levels the past six or so weeks. Steer slaughter is down a little bit, and to really know what's going on there, I'm not sure. Are we backing cattle up in the feedlot? Well, it doesn't really appear to be that way, because weights are not that high. We have had some feeding struggles here as of late, which is going to impact some of this production. Beef production up and pork production both up 2.7% so far year to date, and broiler production up 0.7%. But we've had really muddy conditions. We've started getting some really cold weather in all the plains states. So Texas Panhandle, Oklahoma, and then going up into the northern plains, where mud and cold weather now have negatively impacted feeding margins. We may not see as much. What it comes down to is we're highly variable in production during the winter months because of weather situations, and so that could create some type of weather market at some point where we get a really strong move in the market, and then when we have that type of move, then it may move against us at some point also when a correction comes. So those are just things to keep in mind as we're trying to hit certain markets. We've got a lot going on in the trade world. Aaron talked about China a lot. China's, from our standpoint, is mainly a pork and soybean issue. He mentioned their corn stocks that they decided they told everybody, and who knows why they decided to tell everybody at that time why they have all these corn stocks. But the main issues we're looking at are pork and soybeans. We're also looking at the African swine fever situation in China and in Asian countries there, in parts of Europe. And so what that situation, if a lot of animals end up being done away with, then we could see some support in the beef market. I was reading an article this morning thinking about Argentina. They were talking about Argentina and the bad situation that their economy's in, but yet those people down there keep on consuming beef at a very high rate, which is a good thing. But anyway, the Japan tariff rates is going to be the biggest impact right now that we need to figure out on the beef market. We're still sitting at 38.5% tariff rate. The comprehensive the CPTPP. So the Comprehensive and Progressive Trans-Pacific Partnership, which got renamed to that following the exit of the United States, or not the United States not willing to negotiate with that. Tariff rates to Australian beef are going down and going to go down at a fairly quick clip, and we're already at a disadvantage from a tariff rate with Australia on the beef market. and it's only going to get bigger unless we develop a some type of agreement with Japan for beef markets. Just Japan and Australia are the two major players or Australia and the United States are the two major players in the Japan market, and we've got to do something to lower those tariff rates, or we're going to shoot ourselves in the foot. We still need to figure out for NAFTA and the new U.S. Mexico. There's still some things that need to be worked out with aluminum and steel tariffs, so that we realize the full benefits of this agreement. But it should keep cattle and beef flowing all directions, which is a good thing for our market. We just need to focus on keep on producing our high quality beef, and it'll find the market that wants it. Imports very much in line with year ago levels. That's perfectly fine. Of course, we're just primarily importing a lot of lean beef. A lot of that comes from Australia and New Zealand. Of course, Canada, we import a little beef from Canada and Mexico, but primarily the lean beef, grinding type beef is coming in from New Zealand and Australia. What's amazing is that for the first time, you can look at, let's go back to imports and just look at over the year, we've been anywhere from about 225 million pounds per month to just shy of 300 million. Whereas so far in exports, we've seen very, very similar numbers, and we've had very, 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 very strong exports this year. Most of the time, we're just a net exporter on a value basis on beef, but not on a quantity. So generally, we import more beef than we export from a quantity standpoint, but we export more beef on a value standpoint than we import. But this year, we're a net exporter from a value and a quantity standpoint, which bodes well for the market, which is also why the market has been so strong this year. We thought with increased cattle numbers, with increased slaughter, with increased production, you'd say, oh, man, we should see lower prices. But in reality, we've seen prices really strong compared to a year ago prices. And right now, the fall prices are very much in line with last fall's prices. And I wouldn't say last fall's prices were that low. But the export market is what has really driven that. Sure, domestic demand for beef has been strong, but the export market is really what has been driving the price support that we've seen. Again, we just need to keep on working on those trade agreements, and I think our administration that's in office has claimed that they're going to keep on working on those things. They have a lot going on in DC, but hopefully they will one by one knock some of these trade agreements out and try to see how that benefits the market. I'm looking at beef prices right here, just the box beef cutout value, a composite value of all the cuts, and I do believe we're going to start seeing these prices go down on this box beef, but that's mainly because most of the holiday buying has already occurred. We might see a spike here, 1 week when we see a bunch of cash sales that occur, but most of the holiday buying has already occurred for Christmas and New Year's. It's really funny. There's also a poultry issue here. We keep on expanding poultry production across this country at some rapid clip. And then you hear people that decide, I'm not even going to put a turkey on the table at Thanksgiving. So what are they going to put on the table at Thanksgiving? Well, it'll either be beef or pork. And then when we think about broiler, the broiler industry and the chicken industry, so that's turkeys, and that's part of poultry. But the broiler industry just keeps on expanding, and the export market is not moving it through that channel as well as probably it ought to sustain such growth. So we'll see. It's not like it used to be. Just build it and they'll come. They're building a bunch of stuff, and I think we're going to have some poultry sectors that find out that times are fixing to get tough. Which actually Tyson just reported their annual, their fourth quarter and their their annual returns, and poultry, the broiler industry was a loser this year, and the only reason why they had higher returns was because of the pork and beef industries. So very well diversified company, but poultry is not looking very strong right now. Drought monitor looks really good. Actually, we've had probably more rain than what we need. Probably our biggest lack that we've had across most of the southeast has been sunshine. And when you have a lack of sunshine, it reduces forage growth. Now, most of us have good forage growth from the fall. We've had fairly favorable conditions. A lot better to have too much moisture than not enough most of the time in the fall. If we get some warm weather, you know, this weekend looks like it's going to be pretty good. Maybe we'll get some more growth out of some of this fescue, maybe out of those that have winter annuals. Talking about winter annuals, we look out to the southern plains where there's a lot of grazing of winter wheat. A lot of wheat has still not gone in the ground because there's been so much moisture. And some of the winter wheat that had been put in the ground, not doing that well because it's been too wet, not enough sunshine. Did get a report yesterday that there were people that had bought cattle with the expectation of putting cattle on winter wheat, and then they weren't able to get in all the winter wheat. So they have more cattle than they have grazing. And so what does that mean? A lot of those animals end up in backgrounding situations on concrete or on or in pens somewhere. So that could play into this market. The national hay market is very, very strong. The regional, local hay market, we've got plenty of hay for the most part. Whether it's good quality or low quality, doesn't really matter. It generally sells for the same price. We have a lot of cattle on feed, and we expect placements to be up again when, I guess, next Wednesday is when the values come out for cattle on feed report for November 1. And we expect placements to be up again. We saw really, really strong calf and cattle marketing through auction markets in October. So when we see November 1 cattle on feed, we should see an increase in those numbers again this year. Pretty cheap to feed cattle. Corn prices have started to go up a little bit in feeding country, but it's a good situation. Well, here's the January feeder cattle market. As of yesterday, we did see a little price increase yesterday, which is very good, but we had a $10 decline from essentially the beginning of October. If we look up here at the beginning of October into September, lost better than $10 moving into November. Larry, that goes to show where we lost those dollars in those load lots of cattle, but we didn't lose as much in those load lots as the futures market lost. So basis was actually pretty strong in that case for us. I guess the point of this is you know, we had a really good pricing opportunity back in September and early October. Right now, I do not think it's a very good pricing opportunity looking into 2019. I know this is just January, but if we look at August, because I know there's several people that know they're going to be marketing cattle in 2019 at some point. And so if looking at hedging opportunities on these animals is something people want to do, right now is not the time to do it. We missed our opportunity in September and October. We need to keep our eyes peeled for another opportunity. I think we'll get another opportunity. If the price gets back up in the 152, 153 range, it might be the time to pull the trigger on cattle that will be marketed in that August time period. You know, you can use futures and options. You can use LRP insurance. There's a lot of different things that can be used. Forward contracting is usually not as easy in the cattle industry as it is in the crop industry. So here's the forecast on prices. You know, I don't expect prices to be much different next year throughout the year. So this is covering 10 months of the year. So essentially the next 12 months is what I'm covering here, January through October. We should have fairly decent prices, should be opportunities to make a dollar here and there. As I talked about last week, you know, I reran the numbers again, and they haven't changed on expected value of gain for cattle bought in January and sold in June. We're still looking at a value of gain of $1.21. If you lock in that price, those prices right now, if a producer was to lock in the prices right now using the futures market, they can lock in a value of gain of $1.21. So as long as mortality and morbidity issues are managed, we can lock in $1.21. And if it's costing you 40 or 50 cents, let's say it's costing you 60 cents to put on a pound of gain. Well, that's 60 cents that you're going to profit on every pound that's put on. Not a bad return on your money. I know there can be more dollars than that in this sometimes, but locking in a profit and guaranteeing money's in the bank is not a bad situation. Looking at March to August, because March to August is probably a more normal period for people to purchase cattle, because when grass starts greening up, people are going to start looking at buying these calves. You know, we got a strong expected price on those calves come March, but at the same time, we have a pretty strong value for the sale of those calves in August, or those feeder cattle in August. So a value of gain of $1.11. Well, I would expect your cost of gain during the spring and summer months is cheaper than during the winter months. So we're still probably looking at even though the value of gain is only $1.11, we're probably still looking at very similar margins on cattle bought in March and sold in August. So that's 150 days that we're spending on putting something to those calves. So I do think there's a lot of opportunity to add weight. Calf producer right now, I do think you ought to be holding back those calves instead of marketing them right now. I know people say, well, you know, it's winter's coming on and things are happening. I've got other things to be doing, and it gets dark early. And well, okay, that's fine. Sell your calves to somebody who will make money with them, I guess. Because I think we need to look at this opportunity right now to take 45 days, 60 days, add some weight to them, see what the market looks like in early January if you don't want to hold them any longer, and try to increase the value of those animals. There probably is actually an opportunity to buy some of those old slaughter cows that are cheap right now, adding weight to them and turning them around. That's a little risk. That's a risky proposition in some cases, but things are getting tight on the cow-calf producer, and we're looking for opportunities to make money where we can make it.